Hi, I'm Lyn Adams.
I'm Justin Gross.
Welcome to this edition of Video Insight, and this is our fourth quarter client conference call. Today we're going to jump into some information to share with you what's going on in the markets, what's going on with our strategy, just kind of give you some updates overall on your portfolios. So with that, we'll get started. I guess one of the things we need to point out is that everything in this discussion is for educational purposes only. There's no specific investment advice here. We just want to give everybody an update. So, great year so far.
Yeah, pretty steady. Not a lot of volatility. Do this every year, right?
You know, well, not every year. If it was like this every year, everybody'd be happy. That's just not how it works, though. But just to give you some of the numbers, year to date through the end of the third quarter, the best performing sector as a U.S. investor is the emerging markets. They're up 28.1% if you look at it in U.S. currency. The developed markets outside the U.S. are up 20.5%. Here at home, S&P 500, largest 500 companies in America, are up 14.2%. Small cap stocks, they were really lagging, but they actually had a pretty good quarter, so now they're up actually double digits as well, 10.9%. The hedge fund world and the index that's there is 5.4%. Even bonds up 3.14%. We had a little spike down in interest rates, so that helped bonds a little bit out in the third quarter. And then commodities are actually negative this year. Again, just it's hard to find everybody winning on every front, but so precious metals and sort of the food index and the oil-related areas have been in that commodity space, but the metals have really dragged that down a bit. So it's a good year for a diversified portfolio. We want to maybe talk first a little bit about the U.S. markets, and in terms of the actual, what's going on in the U.S. marketplace. We've got, from the bottom, we're up 272% now. So that's been a long run. And here in the last couple of months, it's just continued to be extended to new highs. If you look carefully at this chart, stocks move higher. One of the things that's interesting is that we're still only at 17.7 times earnings. Now, I'm not saying that's low, but we've been actually higher than that on multiples for a while. But now it's back to 17.7. It wasn't 17.9, it was 18.1. So what that's telling us is there's actually earnings growth, not just people willing to pay more. The earnings growth isn't necessarily coming from an economy that's overheated and running at maximum or at a super high rate per se. It's actually, a lot of it's coming from our companies participating overseas.
Yeah, I mean, even though it's been a long sustained rise, 9 years, it doesn't feel, this is probably not a word, but bubbly. I mean, because the multiple expansion has not gotten out of control. 17.7 may be a little elevated, but not to the point where you're starting to talk about the emotional euphoria and those type things that normally are precursors of
big pullbacks.
Big pullbacks. That's not to say it couldn't happen. Anything can happen, but not a classic bubble here.
If you look at this next slide, earnings and energy earnings, I thought I'd show a little something here that I haven't shown before. So, energy is one of the contributing sectors to the S&P 500, and for really the latter part of 14 through 15, 16, energy was really bad. We just had so much energy reserves that prices fell, so profits from energy were terrible. Now energy's stabilized. The world sort of used all that excess reserves, and prices have risen and is sort of more consistent now. But look at the period from 15 and 16 and how much negative earnings came from energy. You can almost take that chunk and set it in the bigger graph of the whole S&P 500 index earnings, and you can see that big decline in S&P earnings, a lot of it was because of energy, right? So this rise in earnings we have now is still, to some degree, a function of energy having really recovered. Now, you also got some earnings improvements in technology and some other areas, healthcare, health sciences, but this energy picture has been part of it. And as long as energy remains kind of stable, we don't get excess inventories, that's going to help keep the S&P 500 a little bit more consistent on the earnings front.
Yep.
Thought that share. Now, another thing here on this, if you'll notice, the analysts' future next 12 months, their expectations is they're expecting S&P 500 earnings. Right now, they're at 30.51 cents a share. They're actually looking at some pretty substantial increases. They're looking at maybe $34 a share. That's just looking at those 500 companies, what their orders are in the pipe, times their margins, what their earnings would be. So, that's potentially a really good year in earnings growth. right?
Yep.
Let's talk about where some of those earnings are coming from. I think the real story here, the U.S. market is the story within the story, right? The real story is what's going on around the globe, right? We like this global manufacturing data chart. This is essentially a heat map of when things are getting better or when they're deteriorating in different regions around the world on the manufacturing front. Now that's a leading indicator for markets and just economic growth. If you'll look to the far right, right now, the month of September, essentially every country that's in the Purchasing Managers Index is actually positive year over year. They're all green or above 50. 50 is neutral, below 50 is declining, above 50 is growing, right? This is the first time since they've been recording this data, and I think they've been recording this data for about 40 some years now, that every country in the world is moving forward at the same time. So it's a very balanced economic recovery worldwide. And a lot of our companies in the U.S. participate in global earnings.
Yeah.
So I think that's something that's important to note.
It may speak to the point that the world is probably as small of a place as it has ever been globally from a business perspective.
Right.
U.S. companies participating in what's happening abroad, that sort of thing. But it's rare, and it's a good thing.
It is. If you think about this concept of, well, what happens when the world accelerates, right? You've got this sort of worldwide growth story happening, and the U.S. is actually the tortoise. we're the slow growth, right? But it's interesting because in the developed markets, like the U.S. and Europe and UK, the growth is causing us inflation, right? So if you look at this reinflation, this is a heat map for inflation by those same regions that the Purchasing Managers Index records. In all of the developed markets, we're seeing prices rise for labor, for goods and services, because those economies are really working at almost their full capacity, right? Those are older economies with maturing populations that can only produce so much output, right? But now we're getting inflation show up in some of those regions, and at the same time, in the emerging markets, because things are stabilizing, their currencies are stabilizing, they're actually experiencing a little bit of cooling. They've had problems with inflation, so this is good for them, and we've had problems with deflation, for a long time because we haven't been able to see asset prices rise consistently like people would want them to rise. So we really have got a nirvana picture here for the world in terms of right now, earnings, slow growth where it needs to be slow, faster growth where it needs to be fast, the balance sheets, the balance of goods and services and currencies. It's a very nice situation at the moment, okay? Just a few other pieces to look at just to kind of help drive the point. If you look here at this global economic improvement chart, on the left is emerging markets. It's just showing you the economic expansion and the rates of that expansion for emerging Asia, emerging Africa, and emerging Latin America. All of these major regions since mid-15 have been moving up at a very, very good rate, right? On the right-hand side, the more developed nations, the U.S., Japan, and Europe, also all moving forward. This is just natural recovery of earnings. People going to work, spending some money a little bit, not feeling scared to go out and shop and buy things and goods and services. The next slide, more economic data. On the left-hand side, what you're seeing is Europe is actually exporting goods and services again, right? People going to work, they're making product, they're exporting it, so their economy's growing. Bottom left, Eurozone unemployment. It was at 12% in the Great Recession, right? It's all the way back down to 9%. Now Europe, their long-term normal unemployment has never been 4 or 5 like the U.S. They just have a higher level of natural unemployment anyway. In Japan, same thing, real GDP growth is above long-term trend. The labor market, they're down to 2.8% unemployment. That's very low for Japan, right?
It's kind of the same story. Every piece of economic data you look at is saying the same thing. It's slow improvement here. And in some cases, like the emerging markets, a faster improvement, but good signs, good things that we're seeing.
Right. One last note on that front before we move on is that when you get unemployment to 2.8 like in Japan or down to 4.4 like we have here in the U.S., you have to realize that's full employment. I mean, that is about the most that Japan or the United States can actually grow. I mean, we don't have the population right now, all right? So it's a little bit tricky because when you start to get overheated, there's more demand for goods and services that we can create because we don't have the jobs, then your inflation can cause problems. While inflation is as low as it is, it's not problematic, but I wouldn't be surprised if we were out a year from now and we have inflation issues that we got to start seeing the Fed deal with and just cause some things to change in the dynamics of how we invest, right? Or maybe even a surprise and you see the market react to it and sell off because they don't know how to deal with that data, right? Let's talk about the currency situation, right? So as a U.S. investor, if we own international investments, which we took a larger position in emerging markets back, was it February or so?
Yeah, first quarter.
First quarter, and we've maintained a good exposure overseas. When we buy international investments in U.S. dollars, and the U.S. dollar falls relative to the international currencies, which is what is starting to happen as the rest of the world's economies are getting stronger. Their currencies are getting stronger relative to the dollar, and that's fine. But when that happens, if the dollar loses value and we go to exchange our international holding back to dollars, we get more dollars for it. So falling U.S. dollar strength is a good thing for investors in the U.S. if you own international investments. So in local currencies, emerging markets, international have a good year, but it's actually being amplified by the multiplier effect of the currency multiplier. So I think that we've really got two different tailwinds here, right? With investing to look overseas. One is the dollar probably will slowly decay. I mean, there's nothing wrong in the U.S., but everything else is doing really, really well, so they'll be better, potentially. And then at the same time, this economic growth across the spectrum outside the U.S. could give us true growth. So there's a really good opportunity here, we think, to navigate this space, obviously with caution. You know, you never know when the next global terrorism issue is going to pop up, or the next global scandal, or political, or war type thing. You know, there are the outliers that matter, and they're real, and they always are in the mix.
Yeah, but for the first time in a long time, currency is helping those international positions that it's been a while.
It has been a while. It has been a while.
And we always talk about reversion to the mean, no matter whether it's currency or markets, and that's the natural thing I think we're seeing here.
It is. It's probably worth mentioning this. Many of you, for about 4 years, we would do the review, and you would say, why do we have international? Why do we have these international pieces that are dragging our returns? And the S&P 500 was the darling of the investment universe for about 4 years, right? Well, now, international is reverting to the mean. And because we still own it, we benefit from it, right? And that's why you want to have it. It's a diversifier, and it helps us in an environment where the rest of the world is doing well. So.
And the reason always has been and always will be buy low and sell high. That's it.
So last piece on world economic growth is that I want to help you understand sort of on a relative basis here. Look at the chart. The U.S. S&P 500 from the bottom of the 2008-2009 recession period to now is up 272%. It's a long way. It's gone a long way, and we're very thankful that that's been such a great recovery. But the international market's value has only gone up 117%. So it tells us that they have a long way yet to go to get back to the same level of improvement as the U.S. Maybe they'll never get there. I wouldn't say that it's a guarantee of any sort that they would. They may not get there, but it does tell us that there's a lot of road in front of the international markets that could continue to be traveled, and profits to be grown, and fruits to be harvested in a recovering economy. So let's switch gears and talk briefly about this notion of volatility, right? It's really easy for us to settle into, hey, what's my statement this quarter? Oh, this is another good quarter. Or I turn on the TV, hey, record highs again, you know. It's really easy to get into this pattern of this is just how it is. And when it's a long extended period. And this is the 8th year of our bull market, right? So some people, I would say, probably are falling asleep at the wheel. Now the warriors, the worriers, the nervous Nellies, they don't ever fall asleep at the wheel. They're always looking for the exit, right? But a lot of people that got other things going on in their lives, they just let it be, and they can get complacent. We're not in excessively priced range here. 17.7 times earnings is not, like Justin said earlier, it's not bubble-esque. It's not frothy. But on a relative basis, it is higher than the long-term averages. And the dividend yields and things aren't really so attractive to say, we could withstand a big system shock. So we think that volatility is still a risk. What is normal volatility, right? Next chart here, this is just showing you the last 30 years, 35 years. And you can see that during these periods of time, there's a lot of normal volatility where you have minus 10, minus 16 intra-year. And of course, you can have the minus 49s.
Sure.
Like we had in 08, you could have a minus 34 like we had back in, the mid 80s. But normal is a minus double-digit number about every other year.
Yeah, 14.1 is the intra-year average, and we haven't touched that in 6 years, in any of those 6 years.
Right.
So, we've talked about things are looking good, all the economic data points and indicators look good, but don't fall asleep and have a plan before this type of volatility, this natural volatility.
Right.
It won't be a shock to us the
Right.
next time it happens, and it shouldn't be a shock to you. It is natural and it's always there, but let's have a plan for it.
Right. I mean, and here's the reason you want to have a plan, right? Next slide,
Yeah.
limiting large losses, right? If you lose 5%, you got to make 5 or 6% to get back to where you started, right? If you lose 20%, you got to make 25% to get back to where you started. But when you get those larger losses, if you lose 30 or 40%, if you lose 40%, you got to make 67%. I mean, we all know how hard it is to make 67% without taking a lot of risk. I mean, that could be a decade.
And again, we've hit on reversion to the mean, talking about currency, right? Reversion to the mean in this may look like, if you go back and look historically, 40% is a lot of anything to lose. That's almost half of it.
Right.
That's happened 1 out of every 10 years historically.
That's right.
Once a decade, minus 40.
Yeah.
And we're in year.
Well, we're less than a year away from this being the longest bull market in history.
Right.
If we keep moving forward for another 12
Now that does not mean that it has to happen within the next
Right.
year and a half. It could go 5 more years. We don't know. But we want to be ready and have a strategy in place that can capitalize on that.
Right. So I think it's important also we talk to you all the time about our defined risk strategy. It is such a great tool to know that's at work, right? Essentially, 200-day moving average, if the market trends below it, we're going to take some profits, we're going to sit tight in cash, have some dry powder. The market's in a healthy state, a healthy condition above the 200-day moving average, all is normal. We're diversified, a balanced portfolio. I did want to point out that we have a whole section on our website. The Defined Risk Strategy has its own tab under services. I don't want this to come off in any way like a sales pitch, but I really believe that being able to participate in the market while the market is growing, but having a strategy that says, hey, we're going to try to navigate against these large losses with something as we tested so well as a strategy, it's a good thing to have in place. You can share that web link with your brother, your mother, your cousin, your uncle. I mean, anybody has access to that information and show people how it works. Certainly, if you don't know how it works, you need to call us and make sure that you understand how it works, because we really believe it's a very powerful tool right now. But that is our plan. That is our plan when it gets bad, which we know it will at some point.
And it's a different mindset. If we know that historically the negative 40s have happened and that they may happen in the future, probably will at some point, being able to turn those losses into an opportunities where you can go back down and buy some of that, but not only buy, you can always buy some at that point, but do it with preserved assets,
right,
with preserved capital and preserved money. Turns that big scary monster that everybody's worried about into an opportunity.
And obviously, there's holes in any strategy.
Sure.
There are things that could happen where, you have a flash crash, market goes down 20% in one day. It's not going to help you there. But for most instances of natural decay and decline that happen once the market moves under 200-day moving average is when you see acceleration, because the public gets scared, fear sets in, fear mongering sets in, the advertisements for buying gold flare up on TV. I mean, all of these things happen at one time. When it's above the 200-day moving average, we don't see that level of hysteria. Hasn't been present really in many decades. So it's a good strategy. Check it out on the website. Just to wrap up our call today, we didn't talk much about fixed income. Low levels of interest, not a lot of opportunity there to see a lot of growth. We are trying to manage that space. We think our defined risk strategy is a way we can not have to participate as much in fixed income and still provide some safeguards, right? But really not a lot to talk about in the bond world at the moment. So some of the conclusions that we would have is global growth is really balanced and it's very widespread. It's a very good time to be investing in the world. So far this year certainly has. U.S. growth is likely to be slow in the intermediate term. Probably got about 4 or 5 more years before the millennials really start being a real force of economic output in the U.S. But for now, it's probably going to remain pretty slow. But profits may still rise because the U.S. corporations are very smart and they participate and capitalize on the foreign profit growth. All right? The higher the valuations get, the scarier the fall could become. The higher the valuations get, the more difficult it will be for us to have higher long-term growth from that number. Right? It's like if you go up on a roller coaster, when you get up pretty high, when you go down, it's going to be a lot more exciting, right? So we like the fact that valuations are higher, your statements are higher, values are higher. We've got a hedging system in place, but just know that the higher it goes, the more that there's risk that we need to be paying attention to. And stay diversified and have a plan for what to do when you get that scary moment. Anything else you want to add, Justin?
No. It's another good, but kind of somewhat of a boring quarter.
Yeah.
But the boring is good
I think.
sometimes, but it won't be boring forever.
So we'll wrap it up with that. To be conscious of your time. If you have questions, please email us or call us. We'd love to interact with you. For now, we'll just go ahead and go through our disclosures. We appreciate you, and we'll be back with you again next quarter.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
The views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information.